Hi, everybody. Thanks for joining us today. I'm Jasmine from ACE, if I haven't met you before. Again, thanks for joining us this morning. I'm just here to introduce Adam Scott with Wellacre Wealth Management. Thanks so much for talking with us today, Adam, and I'm going to let you take the floor. But thanks so much for sharing your wealth of knowledge, and we'll take it away.
Great. Thanks so much, Jasmine, and thank you, ACE, for having me here today. While we're waiting, and as people come in, please feel free to answer that poll. I'm going to tell you a little story about myself and why I do what I do. When I was 8 years old, my father was walking me to school one day, which was a very rare event. And it was one of the few times I can remember my father having a conversation with me as a child. And he took the opportunity to teach me how to create a perfectly constructed stock portfolio. Strange conversation to have with a child, and strangely enough, I was fascinated. He informed me it required at least 8 different equities of the similar amounts from 8 different industries. Strangest of all was when I discovered 5 years later from my mother that my father had ignored his own advice and put everything he had and our family's entire life savings into one sure thing that sure enough went bankrupt. And my family became financially devastated. We never recovered. This traumatic event made me determined that I would never let anything like this happen to myself or anybody else that I cared about, and ultimately drove me to form Wellacre Wealth Management to help guide families and professionals through potentially tumultuous and turbulent economic events, just like we've experienced over the last year, to try and ensure that people like members of ACE can retire comfortably and don't have happened to them what happened to my family. So that brought me here today, and there's much more to wealth management than simply the investments. There are tax strategies, and we've got a series of webinars coming up to try to protect and help you grow your wealth. These are 5 areas that I regard as being crucial to ensuring your families and your financial well-being. So today we're talking about tax secrets, and this reminds me of the conversation that I had with my father, and somewhat with different results. But unlike this, where it says pass this tax secret down through the generations, unfortunately tax codes change all the time. So these tools change. They may change after January the 1st. Especially if the Democrats win in Georgia and Biden is able to revise what Donald Trump did 4 years ago. So we may need to revisit some of these strategies. However, my guess is many of them are going to stay in place. So today's agenda, the first thing we're going to talk about is avoiding what I call being piggy in the middle. Then we're going to talk about businesses as tax avoidance vehicles. When we look at tax avoidance strategies, there's a prime one, the 199A tax deduction, which a lot of people and their CPAs just either the clients don't understand it or aren't aware of it, and more concerningly, CPAs don't sit down with their clients to try to maximize the 199A deduction. So we're going to talk about that because it's a really major tax break. And we're going to talk about how to minimize payroll taxes if you have a corporation. And we're going to talk about different kinds of retirement funds that often aren't used, that people in the entertainment industry can really take advantage of. And then there's going to be a little bit for everybody about real estate tax secrets at the end. I know people are always interested in real estate. So avoid being piggy in the middle. What do I mean by that? If you're each earning $130,000 a year, that puts you in the 24% marginal federal tax bracket. You're paying, if you're in California, 9.3% California tax, and you're paying 1%. Well, you're paying 1% California SDI tax up to $122,000, and you are paying 15.3% Social Security Medicare tax. Now, if you're self-employed, you see that 15.3% Social Security Medicare tax. I remember when I was a W-2 employee, I never thought much about Social Security and Medicare. I mean, I saw it taken out of my paycheck, but my employer paid the other half of it. So, that you're paying as an employee like 7.6 and the employer is paying 7.6 or 7.65 and you're each paying 7.65. So you think, 7.65, it's not a big deal. But when you're self-employed, you're paying both sides of that. So you're paying this 15.3%. So on $100,000, that's over $15,000 in Social Security taxes that you are paying. Over $137,000, that the Social Security bit drops away. So the point that I wanted to get to here is that all of these different tax rates for the person earning $130,000 add up to 49.6. If you're self-employed, you see this. You see that you're paying almost 50% tax at the marginal rate. Now, what do I mean by the marginal rate? What I mean by that is you're a hardworking editor. You've been working all year. It's coming up to December. You've earned almost $130,000 this year. And now this weekend, the producer said to you, hey, Shannon, I don't know if there's anyone called Shannon on this call, not picking on you, but hey, Shannon, do you want to come in this weekend and work the weekend, right? Well, if Shannon comes in and works the weekend, 50% of what she earns that weekend is going to go in taxes if she's earning around if she's already earned $130,000. So that's what I mean by the tax rate. Now, right at the beginning of the year, maybe it's COVID year, and Shannon has not really worked this year at all. Then she can earn, if she's married, she and her spouse can earn up to $24,800 without paying any tax, because that's the standard deduction. Everybody, if you're a married couple, you can earn $24,800 without paying any tax. Of course, if you itemize and your itemizations add up to more than that, then you can get even more earnings without being taxed on it. And what the effective tax rate is, is how much of your income you end up paying in tax, because you don't pay tax on that first $24,800 if you're a married couple. Then after $24,800, for the next just under $20,000, you only pay 10%. And then the next chunk of money after that, you only pay 12%. Then once you start getting into $80,000 of taxable income, now you pay 22% on anything above that. So for instance, Shannon, who is, if she comes in this weekend and she earns $1,000 of overtime, and she's going to be paying $500 of that in tax, right? 50% of this weekend's income in tax, but she's not paid 50% of her entire year's work in taxes. She's not going to be paying $75,000 in tax. No, when all's said and done, she may only be paying $20,000 in tax. So her effective tax rate would be 20%, but her marginal tax rate is almost 50%. So what I wanted to show you was how high the marginal tax rate is of poor Shannon. Poor Shannon is what I call a piggy in the middle, herself and her spouse, each earning $130,000 a year. Why do I call them piggy in the middle? Because look at this, now on the screen, you should see the current highest income tax rates for somebody living in California. Now, this is for a couple earning over $622,000 a year. But ironically, their marginal tax rate isn't that much different than poor old Shannon being a piggy in the middle at $130,000 a year. So why is that? They're paying a 24% federal tax, and they're paying 12.4% Social Security tax. That's the tax that drops away at $137,000. But together, these two taxes add up to 36.4%. After the piggy in the middle gets over $137,700, that Social Security drops away, the Social Security tax at 12.4. Now, they still pay a little bit of Medicare, as do higher income earners, but that Social Security tax drops away. So they don't get into paying such a high marginal tax bracket until they earn over $622,000 a year. I think it's really important for people to know this, because I think to me, it's incredibly unfair that the people carrying the bulk of the weight of the Social Security system are those, I'm going to say, income earners between about $50,000 and $137,000. Because you might say, well, they're going to get that money back from Social Security. Well, they get a little bit back, but they're getting about 15 cents on the dollar once you earn over a certain amount of income. If you earn very little income, you're going to get more out of Social Security than you put into it. But as soon as you start earning a decent income, you're basically supporting that Social Security system, which I think is a good system to support. I just think it's extremely unfair that these really struggling, what we'll call middle-class workers, are carrying the load. So here is a slide showing marginal tax rate in other states. And actually, it's really important. We can see in New York here, we may have listeners from New York, 47.65, Illinois, 42.25, and we have Nevada, 47.3. So this is for our 24% piggy in the middle. By the way, not all 24% taxpayers are piggy in the middle. Only those 24% taxpayers who are earning under $137,000 a year. So look at Nevada, 37.3, because they have no state tax. Look at that huge difference if you live in Nevada or if you retire in Nevada. And that has important implications for when you're saving, whether you're planning to go to a different state when you retire. This is the top tax rates, similar thing. California's at the top here. Again, Nevada, no tax state, was lower. And states with no income taxes. A list of them here. So you can look at those places if you want to retire out of state. I just wanted to put up some married filing jointly tax brackets here for you to kind of educate yourself. Note that this is your taxable income. So Rockefeller, he had a secret. He said the secret to his wealth was not to pay tax on investment earnings. We're going to look at some of those kinds of strategies, but even more so, I'm going to say, to minimize your taxes, period, is critical to being able to grow your savings. One of the best ways to do that is to build a business. And there's going to be some great strategies in here for people who have loan-out corps within the entertainment industry. But one of the reasons why businesses are such a great tax avoidance vehicle is something that probably doesn't apply to people in the industry, but I'm going to share it with you just so that you'll know, just so you understand the way that America works. Who's wealthier? You got a doctor here. He's had a tough year. He's working in the COVID ward. He's working around the clock, and he's going to earn $1 million this year. And you got Joe the plumber here, who's got a plumbing business, and he pays himself a salary of $150,000 a year, and he thinks of himself as a $150,000 a year kind of guy. And yeah, he is kind of close to that piggy in the middle tax bracket. But he has a plumbing business, and he's got some trucks, and he hires other plumbers, and he's got a big warehouse of plumbing supplies, and he's got a plumbing shop. And his business has actually had a pretty good year because people are doing remodels, and his business has grown. And it's worth $10 million, and it's grown to $11 million. So even though he's only paid himself $150,000 in salary, his wealth has grown from $10 million to $11 million. And he pays no tax on that growth. Meanwhile, that doctor who's earned $1 million a year, as we just shown, on a substantial portion of his income, he is paying over 54% in tax. So the plumber is paying very little tax as his wealth multiplies, and the doctor is paying a lot of tax. Now, this applies to businesses that can be sold. If you grow a business and you sold, I see very simple business owners, dry cleaners or whatever, who are able to take advantage of this type of situation. Obviously, if you are a director of photography in the movie business and you have a loan-out corp, you can't sell that to anybody. Maybe you have a rental business on the side, and you can sell that rental business if it's got a brand name, or even if it doesn't have a brand name. But I just wanted to show you the power of how you can grow wealth without paying tax on it. One of the great benefits of having a business, of course, is it can be much easier to increase your tax deductions. One of the reasons for this is if you're a W-2 employee, there's a 2% floor on tax deductions, even if you can do them. I mean, let's look at travel. If you're a W-2 employee and you take a trip to San Francisco, if your employer wants you to go to San Francisco, the chances are they're going to pay for it. And if they don't pay for it, and for some reason you say you're going to go to San Francisco, you've got to have enough business expenses to exceed what's called the 2% floor from the IRS. And you can only deduct business expenses over that 2%. So it's pretty difficult to do that in any kind of legitimate way. Whereas if you have a business, again, I don't want to advocate tax evasion. I'm not in favor of tax evasion. I would just say it becomes a lot easier that when somebody travels to San Francisco and they've got a business, they can come up with a business reason for going to San Francisco, along with their other reasons, and it can start becoming tax deductible. There are just many ways in which people with businesses seem to be able to maximize tax deductions. Again, I don't want to advocate tax evasion. So I should, by the way, say tax avoidance is legal, and that was said in the publicity for this webinar. Tax avoidance is legal. Tax evasion is not legal. One great deduction, and this is a little bit in the weeds, but it's so important for those with S Corps and sole proprietors to know, is you really want to maximize the 199 QBI tax break, the qualified business income tax break. Now, what is this? This came out of the Trump Tax Act a few years ago, that businesses were allowed a 20% deduction on their what's called qualified business income, which is on their profit. So what does that mean? Let's say you have an income of $200,000 a year, and maybe you're an S Corp, and normally your CPA would just get you to write yourself a paycheck for that. They typically get you to write yourself a bonus at the end of the year for any money you've got left in the business. So let's say you've paid yourself a salary of $100,000 a year. Now, getting to December, you got $100,000 left in the business, and the CPA normally will just get you to bonus yourself, write yourself a paycheck for $100,000. But a much better thing to do is to take that 100,000 as profit, and you now get a 20% tax break on that profit. You don't pay taxes on that, so you only pay taxes on $80,000. Now, the sole proprietor, 100% of their income qualifies for this 199A QBI tax break. So they don't have to do these calculations so much. And it can be a reason for being a sole proprietor. If they've got $200,000 in taxable income, $40,000 of that income will not be taxed. For those people with S Corps, if your CPA has not talked to you about this, and if you've not sat down with them and had them do a calculation about how to optimize your paycheck, you need to contact them and you need to do it. It's getting a little late in the year to do it now, but going into January, if this law doesn't change, at the beginning of January, sit down with your CPA, do the calculation to optimize your deduction. It's not quite as simple as I described, and you're going to have to give yourself a W-2 of a certain amount to maximize your QBI deduction. C Corps don't qualify for this, and I would urge anybody in a C Corp who's got a loan out corporation, the only reason to my mind for having a C corporation is if you're seeking investors. So you want to choose a tax efficient business structure. What are the three kinds of business structures that you can choose? This is a sole proprietor, which means you don't have a corporation. And a great thing is 100% of it right now of your income is eligible for the QBI deduction. So you get the maximum QBI deduction on all your income. Because with an S Corp, you don't get the QBI deduction on the wages you pay yourself. But there is an advantage to an S Corp because you can limit your payroll taxes. Now, what do I mean by this? So let's say you have a corporation, again, that you're bringing in $200,000 a year that you can pay yourself. Potentially, I'm not advocating this, but you could pay yourself $50,000 in wages as an S Corp and pay yourself $150,000 of profit. Well, if you're only paying yourself $50,000 in wages, you're managing to avoid right, 15.3% of Social Security taxes on, all your income above 50,000, between 50,000 and 137,000. In addition, you're also avoiding the Medicare taxes that you would be paying on your income between 137,000 and 200,000. So it behooves you, when you have an S corp, to make your paycheck as low as you reasonably can. Now, the IRS requires you to pay yourself a kind of reasonable wage. So you have to be careful about not making a red flag. So you need to talk to your CPA about this. The other thing with an S corp, if you reduce your wages too much, it's also going to limit your QBI deduction in another way. The IRS does not allow an S corp owner to say, "Oh, I'm going to pay myself $1 and I'm going to take, $200,000 as profit pass-through and get the QBI deduction and pay no payroll taxes." No, the IRS doesn't allow you to do that, but still there's a gray area where you can reduce your wages. So before the QBI deduction came into play, and indeed if it goes away in January, well, then it might behoove the sole proprietor to become an S corp, because they can pay themselves a lower salary possibly and avoid Social Security taxes and avoid Medicare taxes. Most of my business owners who have S corps, they never pay themselves, especially with the QBI, they never pay themselves more than $137,000 a year. Even if you're earning $1 million a year, I still see CPAs wanting to have their S corp owners salary themselves and bonus themselves up to $1 million a year. But then that person is paying Medicare tax, which is 2.6%, on those earnings that they wouldn't have paid if they just paid themselves a salary of $130,000 a year. In addition, they're paying a high earner Medicare tax of 0.9% a year. Now, people look at that and they think it's a total about 3.8%, and they think, oh, well, it's not a big deal. But on $100,000, that's $3,800 a year. If you're earning several $100,000 a year that you're paying yourself unnecessarily as wages instead of just paying it to yourself as pass-through income, that's can add up to tens, more than $10,000 to $20,000 of unnecessary Medicare taxes. So C corps, they can also avoid excess payroll taxes, but they get no QBI deduction. Don't forget about the QBI deduction. Don't shoot yourself in the foot by making your salary so low that it limits your QBI deduction. But we're getting to some good stuff here where the real money is. So retirement cash cows for business owners. I'm going to start with the holy grail of retirement plans here. And I can see that nobody had this kind of plan. The holy grail of retirement plans is the defined benefit retirement plan. It's very similar also to a cash balance, what's called a cash balance plan. This plan enables you to save the equivalent of 100%, 200%, or 300% of your salary pre-tax. Whereas, say, a SEP limits you to 25% of your income. So if your earnings are $100,000, you can put $25,000 into your SEP tax-free. With the defined benefit plan, you could pay yourself $100,000 and put $400,000, $500,000 tax-free into a retirement plan. Well, you might say, well, how does that work? Well, let's say you're a movie director and you're earning $1 million a year. And let's say you've got, you write off $400,000 of expenses and you're left with $600,000 of taxable income. Well, now you choose how much, if you've got an S corp, how much of it are you going to pay yourself as a paycheck, as we discussed before. So let's say you pay yourself a paycheck of $100,000, and now you've got another $500,000 of income that either you're going to pass yourself in profit or then you're going to pay tax on it. Well, if instead of giving it to yourself in profit, you could put it into a defined benefit retirement plan, as I say, where you can put in multiples of your income into the defined benefit retirement plan. You can put enough into it to provide you with a pension for the rest of your life, up to a maximum of $230,000. That's the 2021 limit. These plans, they're very similar to the kind of like the old school union plans, and indeed like the motion picture pension plan, where they're not based on how much you can contribute each year. They're based on how much you're entitled to get out of it. like the motion picture pension plan, if you work a certain amount of hours, you get a guaranteed payment out of that plan. It doesn't matter how well the investments do. The motion picture pension fund is obligated to pay you a certain amount of money every year. Well, this defined benefit pension plan does the same thing. And effectively, the government allows you to put enough money in to guarantee yourself 100% of your income up to this maximum of $230,000. It requires a large excess cash flow. These are the downsides of it. It's best for high-paid business owners with no staff or younger, lower-paid staff. Very good for professionals in the movie industry. As I say, cinematographers, film editors. If you've got a high rate and you have no staff, it's absolutely perfect for you. But they're complex. There can be mandatory funding limits where it's a bad year, but you still got to put something in. If you keep it properly funded, then you won't get into that situation. But you do need to fund it. There's a higher cost to run them, and you have to hire experts to administer and invest the plan. So what may be more interesting to the bulk of the audience, and indeed I can see that some of you already have these plans, are solo 401k plans. For those of you who have SEPs, I prefer the solo 401k. Again, it all depends on the individual, but the solo 401k, by the way, so it's a 401k plan. Again, it's modeled after the kind of traditional employment plan that other employees have, but you're able to do it for yourself, for your own business. But you can't have employees. If it's a solo 401k plan, you can employ your spouse. But if you have other employees, it gets more expensive and more complex, and we'll get to that. So solo 401k, you can put in $57,000, but in addition to that, you can take advantage of the typical 401k catch-up. If you're over 50 years old, you can put in an extra $6,500. So you can put in a total of $63,500, whereas a SEP, you can only put in $57,000. The other great thing about the solo 401k is you can have a Roth account. And as you probably can tell already, I'm kind of a big fan of the Roth contribution, at least having that option in a COVID year to make Roth contributions instead of tax deductible contributions, especially if we think tax rates are going to go up. Also, the way it works is you have two hats. You have the employer hat. You're both your employer and you're your employee. Whereas with a SEP, you're just making an employer contribution, and it all comes as an employer, and it's limited to that 25% of the income. But with a solo 401k, you're also making a contribution as being your own employee. Well, employees, any employee, when they contribute to a 401k, is allowed to contribute, if they're over 50, up to $26,000 a year, 100% of their income. If you only earn $26,000 this year because it's COVID year and you've got a 401k, you can put that entire $26,000 in. Now, if you're under 50, it's $19,500 a year. You can put $19,000 a year, 100% of your income in, right? So it's much easier with a solo 401k if you're not earning, what is it, 228,000. If you want to maximize your SEP, you've got to earn $228,000 this year. But with a solo 401k, you can earn less than that, and still, actually, you could put in more than the SEP. You can put in the $63,500, even though you didn't earn $228,000, because the calculation is different. But again, it's more complicated, and you need to sit down with your accountant, your financial advisor, to figure out, do you want to use the deductible or do you want to use the employee bit? Because the employee bit, you are going to be paying payroll taxes on. So don't forget that. So negatives of a solo 401k: traditionally requires a financial advisor, one who knows what they're doing. There may be some minor fees. There may be some paperwork if it's over $250,000, and actually the fees may get more expensive then. But it's a great choice for high saving, high earning single person businesses. So more common retirement savings strategies. The SEP, I probably don't need to go too much into the SEP. I've already talked about it. What are the advantages of a SEP? The SEP is really simple: simplified employee pension. you're not going to have the paperwork that you need with a solo 401k, and there are no fees. Even like 150, 175 bucks a year you might have to pay with a solo 401k, and sometimes the fees for the solo 401k, if it's a larger 401k, maybe more than that, if you need someone to help you with it. But with a SEP, it's real simple. Anybody can do it. You don't need a financial advisor. Multi-employee 401k. It sounds like only not many people on the call have employees. They get more expensive to institute, and it gets more difficult to favor yourself. I'm not going to go too deeply into it. There are some great things that you can do with a multi-employee 401k. If that is you, feel free to reach out to me and we can talk about it. Simple IRA. Sometimes, and maybe the people with the employees on the call, you might be better off with a simple IRA where it's going to be more affordable for you to put in place. I'm not going to get into the weeds because it probably, for most people, a SEP or a solo 401k is going to be better than a simple IRA. But if you have employees, investigate the simple IRA. Okay, moving past retirement vehicles. Warren Buffett, buy investments that don't produce taxable income. A business is a great way to do that, but there are also certain investments. And here we have the poster child of someone who's benefited from an investment and a business that didn't produce taxable income. One of the reasons why Warren Buffett is so wealthy, and going back to our plumber and doctor, is he pays himself a salary of, I'm going to call it $150,000 a year. But meanwhile, his business doesn't pay him out any income. It just reinvests. Berkshire Hathaway reinvests in Berkshire Hathaway and grows bigger and buys other businesses. So his wealth gets bigger and bigger, and he's not taxed on that wealth. He's only taxed on the very minor income that he takes, which he himself has pointed out that this is a huge problem with the current tax system. But there are ways that you can do this. First of all, if you maximize your retirement accounts, as I say, I particularly like the Roth kind of vehicles. But let's say you're already maximizing out your retirement accounts. You can buy stocks that don't produce a dividend, that are growing. Unfortunately, some of those are really inflated right now, like Google or Amazon, or back in the day, for many years, Apple grew and grew and grew, and it never paid a dividend. So you had your investment grow without paying tax on it. You will only pay tax on it when you sell it. You can also buy municipal bonds, and you're going to be limited on the tax that you pay on those. Or if you buy the right ones, you won't pay any tax on those. We're about to close, but just, people are interested in real estate. And I do just want to point out some attributes of real estate that can be helpful. And I'm kind of prevaricating here because I'm going to talk about the downsides of real estate as well. I don't want everyone jumping into buying real estate. But it's good to know from a tax point of view that you could own a rental, an apartment building, get a stream of income from that apartment building and not pay any tax on that rent, because the IRS makes you automatically do what's called depreciate that building. They say that you're losing money on that building because after 27 and a half years, they say you're going to have to rebuild that building. So they depreciate the value of that building, and you take that as a loss against the rent. And then, of course, you have all of the other costs of the building. So you may be getting a big fat rent. Your building may be going up in the value, but you're not paying any income tax on that rent. You can also do what's called a 1031 exchange, that at a certain point, when you run out of depreciation, you can sell that apartment building, buy a bigger apartment building. And whereas any other investment, you have to pay tax when you sell it, with a real estate, as long as you're buying a similar or like type of piece of real estate, you can transfer the gains and not pay tax on them into the bigger, better building. So you sell your $1 million building that you bought for $300,000. You don't pay tax on that $700,000. You now transfer that into a $10 million building, and you start depreciating that $10 million building all over again. Then you don't sell that building, but one day you die, and you get what's called a step up in basis, or your heirs do on your death. They don't pay any capital gains tax, any taxes on that building, it's as if they had bought it from you on the day of your death, so that they get that $10 million building. If they turn around and sell it, they'll owe no taxes. So that's the case for any assets inherited on death. Right now, there's no capital gains tax. That when you inherit an asset on death, you can turn around and sell it and not owe any taxes. So the conclusion: avoid being piggy in the middle. Know what your tax rate is. One way to avoid being piggy in the middle is if you have an S corp, you can adjust your tax rates. Also, if there are two spouses working together, and under the same business, maybe you've got the same loan out corp, one of you maybe takes a lower salary and one of you takes a higher salary, because you're determining your salaries, so that one of you at least is not paying so much Social Security tax. Or maybe one of you becomes a homemaker and supports the other one, increasing their income, so that you can get out of that $130,000 piggy in the middle tax bracket. Avoid taxes on investment earnings. Businesses, we've just seen it can be a great tax avoidance vehicle. For those of you with S corps, talk to your accountant about maximizing your 199A tax deduction. Minimize your payroll taxes. If you've got an S corp but you earn too much money for the 199A deduction, put in a defined benefit retirement plan to reduce your taxable income so you qualify for 199A. And then we briefly touched on real estate tax secrets. So there we are. Do we have any questions, Jasmine?